Well, to discuss the economic turmoil, we're joined now by Warren Hogan, the ANZ's chief economist. Warren Hogan, thanks for being with us.
Thank you.
But of course, those job numbers, the non-farm payrolls, they're crucial. They've just come out. I know that you expected up 110,000. They've come in up 117,000. Unemployment rate, many expected steady at 9.2%. It's actually 9.1%. Good numbers?
Yeah, no, they are good numbers. They're not exceptional numbers, but they're better than the market expected. And given what's going on in markets right now, I think we're just thankful that they weren't worse than expected, because that would have really made this thing look a lot worse. And these are good numbers. The US economy is not falling in a hole as these numbers are just going to keep that unemployment rate reasonably steady.
But are they good enough to be a circuit breaker? Because there's extraordinary gloom at the moment.
Yeah, no, they're not. There's still going to be plenty of people out there saying that the worst is ahead for the US, that they're going to, renewed recession, this sort of thing. And these numbers won't change that, because the US economy needs to produce 200,000 jobs a month to keep that unemployment rate steady, and it needs to actually produce 300,000-400,000 jobs to really get some optimism that unemployment rate's heading down in a concerted fashion.
Well, what actually started this latest rout? Because yes, there are enormous problems, but we knew about the problems in the US, we knew about the problems of sovereign debt problems in Europe.
Well, Italy's become front and centre. Their markets are under a lot of pressure right now. Their bond yields are rising. They're now above 6%, and the accepted wisdom is Italy can't really keep its fiscal position sustainable with bond yields above 6%. So, the markets are getting quite worried about an acute financial problem there. And of course, Italy makes the whole European sovereign debt crisis move into a new phase. Greece, Portugal, Ireland, these are small economies. These are sort of the size of Victoria sort of thing. Italy is a different ballgame altogether. They cannot be bailed out if they get themselves into real trouble. So that's the acute financial problem. But I think really what's going on here this week is a concern that the US economy is going back into recession. The debt ceiling negotiations went through, and then things went from bad to worse. And really what happened there was, for the first time, the US government's been forced to really consider fiscal austerity type measures. They've been taking an approach so far that they're trying to grow their way out of this. And this week we got the first signs that they're actually going to have to tighten up on their fiscal side.
Just when they need that economy to expand.
Yeah, the Americans' approach to this has been to grow the economy, grow tax revenues. That will get their fiscal problems in order, whereas the Europeans have taken the opposite approach, and they've got nowhere with this. And I think the markets are very spooked by that.
What is your sense? I mean, likelihood of we're not talking double dip, are we? Because they're really too far apart. Likelihood of another recession?
Look, you can't be ruled out, but this week is all about sentiment, and there is a genuine panic in global financial markets. And these things happen from time to time. There's a low liquidity with the northern summer, so some of these markets aren't as deep as they normally would be. But look, I think if this is going to get worse, if we're going to see the US move into recession, it's actually going to be because of problems in Europe. Europe is where the financial fragility is. The Americans have done a lot in the last 2 years to get their economy back in shape, to fix up bank balance sheets, to fix up the household balance sheet. It's the Europeans where they haven't fixed up their banks, and of course their governments are in huge trouble. That this will get worse, and so we've got to watch that European situation closely.
Of course, one thing feeds on another, but if Italy is too big to be bailed out, what happens? Well,
they can be bailed out by the Germans, but this is a step that the European political elite don't seem to want to take. This is the TARP-type solution that the Americans came up with 2 years ago, is to just put a backstop behind all of these sovereign debt markets, and the only backstop you've got is the German balance sheet. But of course, the politics of that is very difficult. But that is really the end game here, is if the Europeans want to stop this and short-circuit this, the Germans have got to step in with the help of the French and put a united front behind this and backstop the Italian and the Spanish government bond markets.
And what about Australia? What does it all mean for us? Of course, we tanked here today. The dollar's gone down, good for exporters. What next?
Well, the Australian financial markets are heavily influenced by what's going on in Europe and America. They always will. We price off the back of those markets. But our economy is all linked into Asia, and so far those economies are doing very, very well. Now, there's no doubt an American downturn in the second half will have implications for Asia, but if anything, the Asian economies are still trying to fight too strong a growth and inflation, particularly in China. So I think for Australia right now, there's no doubt that sentiment will be further damaged, and sentiment in the business and consumer sectors here in the last few months has weakened. So I think the good news is that this sort of financial ruction will keep the Reserve Bank on hold, because the other thing we learned today from the Reserve Bank is that they were very close to raising interest rates on Tuesday.
Which was your call.
We thought they would go, but they were, their wisdom is that they'll wait and see how these global issues played out, and they were right. The things has gone from bad to worse, and so it turned out to be a very wise decision. But if the global scene settles down, then they'll be looking at that inflation risk, because really this economy's actually got very good prospects.
So what's your call for the next month on interest rates? On hold or even a cut?
Yeah, well, no, a cut for Australia really is the calamity situation, and we can't forecast that. We've just got to watch and see. But we're calling no change for the foreseeable future. If the global situation settles down, then a rate hike could come right back onto the agenda. We're not talking about lots of rate hikes, but maybe one or two. Of course, if we get to the situation of a rate cut, it won't be a 25 or a 50 basis point rate cut. We're going to talk about a lot of rate cuts here, and that's what the market's pricing, 125 basis points of rate cuts in the next year or so here in Australia.
Which is actually a very pessimistic outlook in terms of the economy, because while it might be good if you've got a mortgage, it's a really bad sign.
Yeah, well, that's going to go hand in hand with a weak economy, of course, and I don't think you'll find a financial variable in the world right now that isn't being priced for a very pessimistic outcome.
Because I guess this is the great irony. I mean, the Treasurer has been out, Wen Swan's been out today, again trying to reaffirm that we are a very strong economy, as you just said, that we're in the right place at the right time. But if you look at consumer sentiment, I mean, it's completely, consumer confidence has completely collapsed. If this becomes all about emotion, nothing's going to save us, is it?
Well, emotion has a bigger role to play in the short term in financial markets than in the business community. The uncertainties in Europe, or if the situation in Europe deteriorates and the US deteriorates, that will affect business spending plans and investment plans. But what we've got here in Australia is a mining investment boom, huge projects which are being committed to. So they're coming whether we like it or not. Which is a very positive thing, of course, because they're not going to mothball these huge projects on the back of a bit of short-term ructions in global markets, or even a mild recession in the US. And I think that's the worst we're going to get, is a very mild recession. It would almost be, a very, very brief sort of thing. It's not a deep recession in the US. So we've got these projects coming, and they're not turning around. The domestic economy will remain soft. And I think that's part of the new normal for Australia, is that we're not going to have a booming consumer. We're not going to have a booming housing market for many years to come.
Yeah, well, I was going to ask you what will inspire the consumer to spend again? What will give confidence?
Well, I think the consumer's not spending isn't too bad. It's running around average levels. It's just they're not spending where they historically have. In some of our high street stores, they're spending on the internet, they're spending when they're going overseas on holidays, and they're spending on services. I think we're going to see consumption soften a little bit further because confidence has been hit. But I don't think we're going to see the consumer really go back to the sort of spending patterns that we saw in the last 10 years, where for every dollar earned, they spend $1.10. That's not happening. We're saving. We're much more conservative and cautious with our money in this country now.
Well, off the back of the numbers that we started this interview with, do you think markets will start to creep back up?
Yeah, I think they should settle down. The key is Europe here. The next few US data points are also important, but I think the key is Europe. If this is going to get bad in terms of financial crisis type outcomes, then it's going to be all driven by Europe. And the US is looking a little bit softer, but their economic fundamentals in terms of their prospects aren't too bad. But if Europe deteriorates, that can derail the US.
Warren Hogan, many thanks for talking to Lateline.
Thank you.